The invisible leverage nobody counted. It didn't look dangerous. In fact, most people didn't see it at all. And that's exactly why it mattered. To understand why this story is so relevant today, we need to rethink what leverage actually means. Not the obvious kind, borrowed money clearly marked on a balance sheet, but the subtle kind, the leverage created by assumptions, by timing, by structures that only work if conditions remain friendly. This kind of leverage doesn't announce itself. It hides inside normal behavior. For years, markets rewarded efficiency. Capital was expected to work harder. Idle cash became a problem to solve. Institutions optimized portfolios not just for returns, but for precision. Every dollar had a role. Every exposure was measured. At least, that's what it looked like. What went unnoticed was how many strategies relied on the same quiet support systems. Stable funding, predictable correlations, liquid exits. Individually, none of these looked like leverage. Together, they amplified outcomes far beyond what models suggested. This invisible leverage spread gradually, not through risk-taking, but through refinement. Strategies became tighter, margins slimmer, tolerance for deviation shrank. The system didn't feel aggressive. It felt disciplined, controlled, professional. As a result, exposure increased without anyone consciously choosing it. Positions grew because they could. Risk appeared contained because volatility stayed low. Leverage didn't show up as debt. It showed up as dependence. Dependence on timing, on continuity, on the assumption that adjustments could always be made incrementally. The more efficient the system became, the less room it left for error. Small movements mattered more. Small delays mattered more. Yet because nothing had gone wrong yet, these dependencies remained theoretical. This is how invisible leverage becomes dangerous. Not when it's created, but when it's ignored, when outcomes look stable enough to trust, and structures become so familiar they stop being questioned. Because leverage doesn't need borrowing to exist. Sometimes, all it needs is confidence, and that confidence was about to be tested. As this form of leverage embedded itself deeper into markets, it became harder to distinguish strength from dependence. Performance looked stable. Drawdowns were shallow. Risk reports showed comfortingly small numbers. On the surface, everything suggested restraint. But restraint was no longer the right word. The system had become finely balanced. Strategies depended on precise sequencing. Funding needed to roll smoothly. Hedges required correlations to behave within narrow ranges. None of these conditions were extreme, but all of them needed to hold at the same time. What made this leverage invisible was that it didn't arise from ambition. It arose from optimization. Each improvement made sense on its own. Reduce idle capital, improve efficiency, minimize variance. Over time, these improvements stacked. The margin for error shrank quietly. Institutions believed they were safer because they were more precise. They trusted their controls because outcomes had been consistent. Yet precision can mask fragility. Systems tuned for accuracy often struggle with surprise. When something deviates, there is little slack to absorb it. As more participants adopted similar optimizations, the environment itself changed. Markets became smoother during normal periods, but more sensitive at the edges. Small disruptions traveled further. Minor delays had larger effects. The system responded faster, but not always better. Risk managers monitored the usual indicators and felt reassured. Volatility remained low. Losses stayed within limits. Stress scenarios appeared manageable. What those indicators could not capture was interdependence. The fact that many strategies now require the same conditions to remain stable. This was leverage without a price tag. No interest payments. No margin calls. Just an unspoken reliance on continuity. As long as nothing broke, it worked beautifully. And because it worked, nobody asked what would happen if continuity itself became uncertain. The system was not overextended in appearance. It was overdependent in reality. And dependence is only visible when it is tested. That test would not come from excess. It would come from interruption. The conflict emerged the moment continuity faltered. Not dramatically, not suddenly, just enough to disrupt timing. A delay in funding, a shift in correlation, a price move that arrived earlier than expected. small changes that should have been absorbed. Instead, they cascaded, because when systems are tightly optimized, they rely on sequence. When one step arrives out of order, adjustments collide, hedges misalign, funding mismatches appear. What once felt controlled begins to feel rushed. This is where invisible leverage reveals itself. Positions that seem modest suddenly behave as if they are larger. Losses accelerate not because prices collapse, but because reactions compound. The system doesn't have time to adjust smoothly. Participants responded by tightening controls, reducing exposure, preserving flexibility. Each action was rational, but the system no longer had slack. Reductions came faster than replacements. Liquidity thinned. Prices moved further with each transaction. What made the situation unsettling was that nothing felt excessive. There was no speculative frenzy to blame, no obvious recklessness, just a structure that required everything to remain orderly. When order weakened, even slightly, outcomes changed sharply. As stress built, dependencies became visible. Strategies that appeared independent began moving together. Correlation spiked. Hedging relationships broke down. The same mechanisms that enhanced efficiency during calm now transmitted pressure during disruption. Risk measures lagged reality. They captured outcomes after they occurred, not before. By the time reports reflected stress, decisions had already been forced. Invisible leverage does not announce itself in advance. It reveals itself through behavior. The system had crossed a threshold. It was no longer responding to information. It was responding to constraint. And constraint does not negotiate. It tightens. The buildup was complete. What had been optimized for precision was now exposed to uncertainty it could not easily absorb. The moment everything became clear was not a collapse, but a recognition. The system had not taken on more risk. It had removed its ability to absorb it. What looked like discipline had quietly eliminated flexibility. Invisible leverage did not fail because it was hidden. It failed because it was shared. Too many strategies depended on the same uninterrupted conditions. Too many structures required timing to remain precise. When that precision slipped, the response was immediate and unforgiving. Afterward, explanations focused on specific triggers: a funding shock, a correlation break, a sudden move. But these were catalysts, not causes. The real cause was dependence. A system optimized so tightly that even small interruptions produced outsized consequences. Once conditions normalized, much of the machinery returned. Models were adjusted. Buffers were increased. Language shifted toward resilience. Yet the temptation to optimize never disappears. Efficiency always looks attractive during calm periods. Precision always feels safer than slack. This is why the story continues to matter. Because invisible leverage is not a historical artifact. It is a recurring outcome of success. Whenever systems work too smoothly for too long, they invite overconfidence in continuity. Markets are not fragile because they are complex. They are fragile because they are interdependent. Strength comes not from eliminating inefficiency, but from preserving room to adapt when efficiency fails. The next time everything appears perfectly balanced, the real question is not how well it works today. It is how much it depends on tomorrow looking exactly the same. Sometimes the smallest shift in perspective becomes the beginning of a new future. The invisible